the Bank of England has finally followed up on one of its heavy hints and delivered the first interest rate rise since July 2007, even though several reasons it had given for prior inactivity remain valid, notably poor wage growth and the uncertainty created by Brexit. Nevertheless, the base rate was nudged up from 0.25 to 0.5%, taking us back to where we were in August 2016. Above target inflation figures and low unemployment appear to have tipped the balance, while Governor Carney and colleagues had already also flagged concerns over galloping growth in consumer debt. The vote was 7-2 in favour of the rate rise, but the Monetary Policy Committee statement was as carefully couched as ever, noting that any future increases in the headline cost of borrowing would be, and I quote, gradual and limited. Note that LIBOR, the interest rate at which banks are prepared to lend to each other, is trading at just 0.75% for 12 months' time, implying the market expects just one more 0.25% rate rise by this time next year. Such a very gentle tightening of monetary policy is unlikely to spook financial markets too much, although investors do need to focus on three different arenas. The first is sterling. The pound actually fell on the news of the rate rise against the dollar from 132.20 to 131.15. On a trade-weighted basis, sterling still lost around 11 or 12% since the Brexit vote last summer. A relatively weak pound may encourage investors to stick with the pound down, FTSE 100 up trade, which has dominated since the Brexit referendum. And only a rapid-fire round of rate hikes could probably take sterling markedly higher. If the pound does ever reclaim some of the lost ground, that could help retailers, owing to lower import costs, lower inflation and improved consumer spending power, and also focus attention on other downtrodden domestic sectors, like real estate investment trusts, which have generally been ignored in favour of dollar earners, exporters and overseas asset players like engineers, miners and forestry and paper stocks. The second arena to look at is bonds. Now, whether you're investing in government or corporate bonds, you will face three key risks: credit risk, inflation risk and interest rate risk. And rising rates are generally bad news for bonds. Bond prices can go up when yields and interest rates fall, but they can go down when yields and interest rates rise. Now, this is less of an issue if you buy an individual bond, hold it to maturity and all goes well. But it's potentially a big issue for bond funds, whether they're active or passive, as they don't mature. So the fund's value could fall, and do so by an amount which more than offsets the yield they offer, especially if interest rates start to move higher faster than the market currently thinks. Note, however, that bond yields fell and prices rose on the announcement to suggest fixed income investors took the message about gradual and limited rate rises very much to heart. And then the third area, well, that is of course stocks and the stock market. The FTSE 100 took the interest rate announcement in its stride, adding a few points to a gain it had already made in early trading. In general, interest rate increases can make life a bit harder for stock markets. This is because increased rates on cash, higher yields on bonds, mean investors can get improved returns here, so they may become less inclined to take the risk associated with shares. There have been 10 interest rate increase cycles since the FTSE All-Share began in 1962, and the index has actually done better when interest rates have been going down rather than when they've been going up. From the first to the last move, the average gain during cutting cycles has been 25%, the average gain during hiking cycles has been just over 11%. Now, the wide range of performance during rate hike cycles, well, it's very big. 4 losses, 6 gains from the first increase to the last since 1962. And the UK stock market has been historically able to take the strain of higher borrowing costs, providing underlying economic growth and corporate profits growth has been good. The exceptions were 1972-3 and 1976, when inflation was galloping away rather than crawling along as it is right now. The strength of the UK economy probably remains the big question this time around. Growth looks stuck in the sort of 2% year-on-year range, and if the Bank of England thinks this number merits a rate rise, then that probably doesn't necessarily say that much for the UK's long-term growth prospects, if such mediocre progress is kind of the new normal. If growth does remain subdued and interest rates remain low by historic levels for some time to come, then the strategies which have done well in the past few years, momentum and income, could keep working well, providing valuations don't get stretched. But if the Bank of England is onto something and inflation may be coming, then those strategies could fall by the wayside or at least work less well. Superior inflation protection has historically come from value strategies and cyclical stocks, real estate and oils for example, along with miners, commodities and plays on real stuff like property and gold, as well as index-linked bonds. Thank you for watching, and I look forward to seeing you next time.